You need to turn off your monitor. The number you see on that screen is a lie. You are looking at a financial ghost. Right now, if you load up the ticker in New York, you will see silver trading at $74. You see the red and green candles moving. You think you're watching a market? You are not. You are watching a hallucination. You're watching a digital mirage that is designed to distract you from what is actually happening in the real world. Because 5,000 miles away, the price is not $74. In Shanghai, the physical silver market is trading at a premium that converts to $100 per ounce. This is not a small spread. This is not a rounding error. This is a $25 gap between the American fantasy and the Asian reality. In the professional world of high-frequency trading, we do not call this a discrepancy. We call it a broken market. We are witnessing the complete failure of the global pricing mechanism. The connection between the paper derivative and the physical atom has been severed. If you're basing your financial decisions on the price in New York, you're betting on a system that has already collapsed. You just haven't heard the crash yet. To understand why this gap exists, you have to understand the nature of the lie. You have to understand the difference between a promise and a possession. In the United States, the spot price is determined by the Comex futures contract. This is a paper promise. It is a legal agreement to deliver silver at a future date. But the market assumes that there is an infinite amount of silver available to back these promises. Traders buy and sell these contracts millions of times a day without ever touching a single bar of metal. They are trading digital receipts. Because they are trading receipts, the supply is theoretically unlimited. If the price starts to rise too fast, the banks can simply print more contracts. They can flood the market with paper silver to dilute the demand and suppress the price. This is how the game has been played for 50 years. It is a casino where the house controls the number of chips. But in China, the casino is closed. The market in Shanghai is not driven by speculators flipping contracts for a quick bonus. It is driven by industrial desperation. This is a physical market. It is a market of atoms, not bits. In China, you have massive solar panel manufacturers who need silver paste to build their photovoltaic cells. You have electric vehicle giants who need silver contacts for their battery management systems. You have an entire electronic supply chain that cannot function without this conductive metal. These buyers do not want a piece of paper that says they own silver. They want the metal on the factory floor. They need to feed the assembly lines. Here is the critical difference. You can print a paper contract, but you cannot print a silver molecule. When millions of industrial buyers compete for a limited supply of physical atoms, the price disconnects from the paper reality. It goes vertical. The reports we are analyzing confirm that while the official spot price in China shows one number, the actual price to get metal in your hand is significantly higher. The premiums charged by the refiners and the middlemen have exploded. If you want immediate delivery of industrial-grade silver in Shenzhen today, you're paying close to $100. This price tells us the truth. It proves that the inventory is gone. When the street price rises $25 above the global benchmark, it means there is a localized famine. China is starving for silver, and because they are starving, they are willing to pay any price to survive. This desperation has created the most obvious arbitrage opportunity of our lifetime. Arbitrage is the force of nature that usually keeps global prices aligned. If gold is cheaper in London than it is in New York, a trader will buy it in London and sell it in New York to pocket the difference. This buying and selling closes the gap. It creates equilibrium. But right now, the silver gap is wide open. It is a gaping wound in the financial system. Let's do the simple math on this trade. It is the mechanism that guarantees the US price must rise. If you are a global bullion dealer, you have a simple choice. You can sell a bar of silver in New York for $74, or you can put that same bar on a cargo plane, fly it to Shanghai, and sell it for $100. The cost of shipping and insurance might be 50 cents. The profit is over $25 per ounce. This is a risk-free trade. It is an infinite money glitch. There is no speculation involved. You buy low in the West, you sell high in the East. So why hasn't the gap closed? Why is the price in New York still lagging? This is the most terrifying part of the story. The gap hasn't closed because the physical transfer takes time, but it is happening at maximum velocity. Every available bar in London, Zurich, and New York is being allocated for export. The vaults are being swept clean. There's a giant sucking sound coming from the east as this metal is vacuumed out of the west. We are watching the depletion of Western strategic reserves. The local supply in New York is dropping towards zero. This leads us to a mathematical inevitability. When the supply in New York hits zero, the price must rise. It has to rise until it becomes too expensive to ship the metal to China. It has to rise until the arbitrage window closes. This means the US price has a mathematical destiny to hit $100. It is not a theory. It is hydrodynamics. Water finds its level. Right now the level is 100. The West is leaking its wealth, and the only way to stop the leak is to raise the price. We are watching the end of the decoupling. For 50 years, New York set the price, and China accepted it. If silver dropped in New York, it dropped in China. That relationship is dead. The roles have reversed. China is now the price setter because China is the primary consumer. New York is the price taker. The consumer always sets the final price. If Samsung and BYD are willing to pay $100, then silver is worth $100. It does not matter what a trader at JP Morgan sees on his computer screen. The real price is the price at which a transaction actually occurs. And right now, transactions are occurring at triple digits. This realization is slowly starting to hit the Western traders. They are waking up to the fact that $74 was a gift. They are realizing that if they don't buy now, the metal will be gone forever. They are chasing the Chinese price. This is the catch-up trade. We saw this with palladium. We saw it with natural gas in Europe. When a regional shortage develops, the global price snaps upward to match the highest bidder. We are in the middle of that snap right now. The dam is broken, the East has set the price, and the West is about to panic. We need to talk about the banks. These are the entities that are currently short this market. For 40 years, they have told us that silver is abundant. They have told us that supply is endless. Right now, they are staring at a screen that shows a $100 price in Shanghai and a $74 price in New York. And for the first time in history, they are realizing they are on the wrong side of the most violent trade in the world. Usually, the banks love this setup. If a bank sees a $5 gap between markets, they step in immediately. They buy the cheap asset. They sell the expensive asset. They pocket the difference. It is their bread and butter. But today, the banks are paralyzed. They are not moving. Why? Because to capture this arbitrage, you need physical metal. You cannot ship a paper short contract to China. You have to ship a physical bar. And the banks do not have the bars. They leased them out years ago. They sold them. They rehypothecated them. The vaults in London, which used to be the overflowing stockpile of the West, are running on fumes, so the banks cannot close the gap. Instead, the gap is closing them. Every time a trader in Shanghai bids the price up to $100, it acts like a margin call on the New York short seller. The global price is rising, dragging the Comex liability up with it. The banks are bleeding out. They are losing millions of dollars an hour on the mark-to-market value of their short positions. This forces a drastic change in strategy. For decades, the strategy was cap and contain. Sell paper to keep the price down. Today, the strategy is survive and exit. We are seeing signs of massive short covering. The banks are not adding new shorts to stop the rally. They are buying back their old shorts to get out of the way. Look at the open interest data. It is dropping. And when price goes up and open interest goes down, it means shorts are leaving the building. They are admitting defeat. They are handing the keys of the market over to the bulls. This removes the ceiling. Without the heavy hand of the bank suppressing the price, silver is free to float to its natural level. And as China has shown us, that natural level is $100. In the world of finance, we call this a widowmaker trade. A widowmaker is a trade that looks smart but destroys anyone who touches it. Shorting Japanese bonds was a widowmaker. Right now, shorting silver is the ultimate widowmaker. Why would anyone stay short when the physical market is trading at a 30% premium? It is financial suicide. The only people still short are the ones who cannot get out. The entities that are too big to exit without spiking the price to $200, they are trapped in a burning theater with a door the size of a mouse hole. Their only hope is that demand collapses. But as we discussed, demand is inelastic. Samsung isn't stopping. Solar factories aren't stopping. This creates a powder keg. If one major short holder decides to panic, if they decide to buy back everything at market price to save themselves, we get a flash melt-up. We could see a day where silver moves $10 or $20 in a single session just because one bank decided to survive at the expense of the others. There's no honor among thieves during a liquidity crisis. Let's look at the dealer reaction in the US. If the price in China is $100, why are US dealers selling for less? The answer is they aren't. Go to a dealer site right now. Look at the premiums on a silver eagle. Spot is 74. The eagle is likely 90 or 95. The physical market in the US is already pricing in the China move. Only the paper market is lagging. This confirms that the disconnect is purely a financial phenomenon. The banks are using algorithms to hold the paper price down while the physical world is transacting at much higher levels. This tension cannot last. Eventually, the paper market breaks, the shorts capitulate, and the price gaps up to meet reality. We are watching the last days of the $70 range. The mechanism is broken. The shorts are trapped. And the calendar is about to force their hand. Now let's look at the calendar. It is not just a list of days. It is a series of ticking time bombs. Tomorrow is Wednesday, December 31st, New Year's Eve, the final trading day of 2025. This is the most critical closing bell of the year. Why is tomorrow so important? Because of greed. Portfolio managers are paid based on their performance numbers as of December 31st. Their yearly bonuses depend on the closing price of the assets in their book. If a hedge fund manager is long silver, he wants the price to close at the absolute highs. He wants to mark his books at $75 or $80. This creates a massive incentive for what we call window dressing. Funds will be buying aggressively tomorrow. They will be painting the tape. They want to push the price up into the close to maximize their fees and their reputation. They want to show their clients that they own the best performing asset of the year. This institutional buying pressure acts as a massive tailwind. It means the dip is unlikely to happen tomorrow. The big money is incentivized to buy, not sell. And remember the tax selling pressure we saw earlier in the week. That ends tomorrow. Once the tax year closes, the selling pressure evaporates completely. So you have funds trying to push the price up and sellers disappearing at the same time. That is the perfect recipe for a breakout. We could easily see silver challenge the $77 level by the time the ball drops in Times Square, but we need to look beyond tomorrow. While the traders are obsessed with the December 31st close, the real money is looking at January 2nd. That is the first trading day of 2026. It is the day the rules of the game change. We have to talk about the pension funds. Global pension funds manage roughly $50 trillion in capital. Currently, their allocation to commodities is near historic lows. Their allocation to silver is effectively zero. It is a rounding error. But in 2025, silver was the best performing asset on the planet. Bonds lost money. Real estate stagnated. Tech stocks were volatile. Silver went vertical. So right now, the investment committees at these pension funds are holding emergency meetings. They are realizing they missed the boat. They are saying we need inflation protection, we need hard assets, we need to buy the winner. Here is the math that breaks the market. If these funds decide to move just 0.1% of their capital into silver, that is $50 billion. $50 billion of new buying power? Now compare that to the size of the actual silver market. The entire annual mine production of silver is worth roughly $25 billion at current prices. Do you see the mismatch? The pension funds are trying to buy 2 years' worth of global production in the first week of January. They are trying to push an elephant through a keyhole. The only way the elephant fits is if the keyhole gets bigger. The price must expand to accommodate the capital. This is why the move to $100 is not just possible, it is necessary. The price has to rise to a level where $50 billion buys a meaningful amount of metal. At $74, $50 billion buys everything. At $200, it buys a reasonable stake. The liquidity wall entering in January will force a repricing event. This buying is automatic. It is mandated. It does not care about the chart. It just buys, and it will be buying into a market where China has already vacuumed up the float. It is the unstoppable force meeting the empty object. We also have to discuss the industrial panic driving this floor. Why is China paying $100? Is it a bubble? No, it is inelastic demand. China controls the solar panel industry. They have production targets to meet before the end of the year. If a factory manager runs out of silver paste, he shuts down the line. The cost of shutting down a gigafactory is millions of dollars a day. So if the silver price jumps to $100, he pays it. He doesn't care. The cost of the silver is tiny compared to the cost of the failure. This is why industrial demand sets the floor. Investors might sell at $100 to take a profit. Industry buys at $100 to stay alive. The floor is moving up because the desperation is moving up. We also have to consider the currency war. The Chinese yuan is weakening slightly against the dollar, but silver in yuan terms is exploding. This creates a safe haven bid inside China. Chinese citizens are seeing their property market collapse. They are seeing their stock market wobble. They are rushing into gold and silver to protect their savings. This retail mania in China is layering on top of the industrial panic. It is a dual-engine rocket. So what happens next? The arbitrage gap is $25. New York is trading at a 30% discount to Shanghai. This is the biggest discount in history. It creates a massive opportunity for the U.S. investor. You can buy silver in the U.S. for $74, knowing that the true value in the physical market is already $100. You're buying dollars for 74 cents, but this window is closing fast. The arbitrage bots are working. The ships are loading. The inventory is moving. Once the vaults in New York are empty, the price will reset overnight. We could see a limit up move that takes us straight to $80, then $85. The market is trying to find equilibrium, and equilibrium is much, much higher. The setup for tomorrow is explosive. The East has spoken. The price is $100. Now the West has to listen. We need to look at the delivery mechanism. This is where the paper market finally dies. We are entering the January delivery month. Traders who bought contracts for January delivery are about to ask for their metal. Usually, these traders just roll the contract forward or settle for cash. It is easier. It is cleaner. But today, the math has changed. With the Shanghai premium at $25, why would you ever settle for cash at $74? You would be throwing money away. If you take physical delivery of the metal, you can sell it to China for $100. You make $25 an ounce instantly. The incentive to stand for delivery is the highest it has ever been in history. Every rational actor must take the metal. This means the drain on the Comex vaults in January will be catastrophic. They could lose 10 million, maybe 20 million ounces in a single month. If that happens, the registered inventory hits zero and the game ends. The banks know this. That is why they are panic buying right now. They are trying to front run their own clients. They are racing to the bottom of the vault, and the vault is shallow. So when you look at the chart today, do not see it as a price. See it as a countdown clock. Every cent it rises is a tick closer to the moment the vault runs dry. Every cent it rises closes the window for the paper shorts to escape. We are counting down to a default, a soft default where paper settles for paper and metal settles for a king's ransom. We also need to discuss the black swan risks for 2026. The world is unstable. We have conflict in the Middle East. We have tension in the Taiwan Strait. We have a debt ceiling crisis brewing in Washington. Any one of these events could trigger a flight to safety. In the past, safety was the U.S. Treasury bond, but in a debt crisis, the bond is the risk. So capital flees to the neutral reserve asset. If a war breaks out, oil spikes. When oil spikes, mining costs go up. The floor for silver rises. If a currency fails, gold spikes. When gold spikes, silver follows. Silver is the call option on chaos. And looking at the geopolitical map, the probability of chaos is 100%. China knows this. That is why they are paying $100 an ounce. They are not overpaying. They are paying the war premium. They are securing the metal before the sea lanes close. The West is sleeping. The East is preparing. Let's talk about the psychology of 3 digits. $100. It is a magical number. When an asset crosses $100, it changes how people perceive it. At $99, silver feels like a commodity. At $100, it feels like a store of value. It gains legitimacy. It attracts the wealthy saver who didn't want to mess with cheap coins. Now, silver is a prestige asset. This brings in the family offices. This brings in the high net worth individuals. They want to own the asset that just crossed the century mark. They want to hold the bar that is worth $20,000, not $5,000. Density of value matters to the rich. As silver gets more expensive, it becomes more practical for large wealth storage, not less. But we must also prepare for the reaction. We need to prepare for the regulation narrative. When silver hits $100, the government will blame you. They will say it is speculation. They will talk about market stability. They might raise margin requirements again. They might launch an investigation into hoarding. This is noise. It is the sound of a government losing control of its currency. Do not let them gaslight you. You are not the problem. The $36 trillion of debt is the problem. Silver is just the smoke detector. The debt is the fire. You do not smash the smoke detector to put out the fire, but they will try. Be ready for it. Ignore it. Keep stacking. The setup for January 2nd is perfect. We have the pension funds entering. We have the industrial restocking. We have the Comex delivery cycle. We have the Shanghai arbitrage. We have the geopolitical hedge. All 5 forces are pushing in the same direction. There is no counterforce left. The sellers have left the building. You have survived the bear market. You have survived the manipulation. You are now sitting on a winning lottery ticket. But holding a winning ticket is dangerous if you do not know when to cash it in. In this final breakdown, I'm going to give you the exit strategy. I am going to explain why selling for dollars at $100 is a mistake. I am going to teach you the ratio trade, the secret tool the wealthy use to lock in gains without ever going back to fiat currency. Let's address the urge to sell. Why do you want to sell? To get profit. But what is profit? It is dollars. It is fiat currency. You are trading the scarcest, most strategic industrial metal on Earth for a piece of paper that the government prints by the trillion. Think about the macro environment. The debt is $36 trillion. Inflation is resurging. The bond market is cracking. The dollar is the burning building. Silver is the fire exit. If you sell your silver at $75, you're running back into the burning building because you found a few extra dollar bills on the floor. It does not make sense. The smart money never sells for cash. They swap. They trade one undervalued asset for another undervalued asset. They move from the overheated room to the cool room. They never step outside into the cold air of fiat currency. So what do you swap for? Gold. But gold is the easiest to track right now. With gold at $4,500 and silver at $75, the ratio is 60 to 1. It takes 60 ounces of silver to buy 1 ounce of gold. Historically, this is still cheap. In 1980, the ratio hit 17. In 2011, it hit 30. Geologically, it is 8. Here's your roadmap for the exit. Zone 1. The ratio is above 40. You hold. You accumulate. Silver is still the best horse in the race. It has more room to run than gold. Zone 2. The ratio hits 30. This is your yellow alert. The market is getting frothy. You might swap 20% of your silver stack for gold coins. You're locking in the volatility. You are trading the wild silver for the stable gold. Zone 3. The ratio hits 15. This is the red alert. History tells us that 15 to 1 is unstable. It marks the peak of the mania. At 15 to 1, silver is historically overvalued relative to gold. This is when you make your move. You walk into the dealer, you hand over your monster box of silver, you walk out with a tube of gold. You have effectively tripled your gold stack for free. You never touched a dollar, you never paid capital gains tax, you just played the ratio. This is how dynastic wealth is preserved. You move capital from the high volatility asset to the low volatility asset at the peak of the cycle. We are not there yet. At 60 to 1, the ratio screams buy silver. But you need to know where the exit is before the theater catches fire. 15 to 1 is the exit. Now let's look at the immediate future. The first week of January. We enter the new year with maximum momentum. New York is trading at 75. China is at 100. The gap must close. I predict that in the first 5 trading days of 2026, we will see silver break $80 in New York. The January effect, buying combined with the arbitrage vacuum, will be too strong to stop. We might see a gap up on January 2nd that shocks the world. The banks will try to fight it. They will release bearish reports. They will talk about interest rates. But they are fighting physics. They cannot print silver. Until they can, the price has to rise to ration the remaining supply. So here's the final verdict on the China $100 news. It is the most significant signal of the decade. It proves that the paper price is dead. It proves that the physical price is the only thing that matters. The world has bifurcated. The East has the metal and the high price. The West has the paper and the low price. But nature abhors a vacuum. The West is about to get a wake-up call. If you're holding silver, you're holding the winning hand. Do not fold. Do not get shaken up by volatility. Do not sell for pennies when dollars are coming. The transfer of wealth is not coming. It is here. It happened while everyone was watching the stock market. You saw it, you acted. And now enjoy the ride. 2026 is the year of the squeeze, and you are ready.